Hey, No Pants people, we've got a very special guest expert for you. Today I'm talking with Josh Bauerle, and he is the official CPA of Entrepreneur on Fire. He is also a Series 65 licensed financial advisor, and he's going to have some great insights about tax time for us. I know we all hate taxes, but I'm excited for him to hopefully demystify some of the process and some of the confusion around taxes. And hopefully he can tell us how we can keep more money in our pockets. But before we get into all that, Josh, I hope I didn't butcher your last name. And I would love for you to introduce yourself to us. Just tell us where you're from, what you like to do, and what your business is.
Yes, I know you actually said the name perfectly, which is pretty
okay. Good.
You asked me. No, I'm from. I live in a little town in Ohio called Monroeville, Ohio. It's about an hour south of Cleveland, kind of in the middle of nowhere. And lived all over the place: Cleveland, Columbus, Denver, Colorado. And we had twins about 3 years ago, and my wife said it was time to move home, so we came home.
Well, congratulations!
Thank you. I am the founder of CPA on Fire, which is a tax and accounting firm that specializes in working specifically with entrepreneurs, and especially the online entrepreneurs. So people like podcasters, bloggers, e-commerce sellers, freelancers that can work remotely anywhere, all those kind of people that can basically the location independent entrepreneur. So we've been working almost exclusively with those type of entrepreneurs for about 4 years now. I started my own firm almost exactly 5 years ago. And before that, I worked in all the various forms of accounting. I worked at a Fortune 500 company. I worked at a public accounting firm. I did financial advising for a little bit, and finally discovered that none of the jobs were the problem. I just didn't like being an employee. So I went and did my own thing, and 5 years later, here we are.
Sounds familiar. No, I love that we're getting to talk to you, because I'm so excited that you're actually a expert in this field specifically for the online entrepreneurs, for the freelancers. So I'm really excited to hear some of your insights. So what made you decide to, I guess, work with entrepreneurs specifically?
Yeah, so you mentioned Entrepreneur on Fire. When I started working with him, well, first of all, I kind of always knew that small businesses was who I wanted to work with, because when I was in the accounting firm, those were kind of the people that I thought were being ignored a little bit, because for an accounting firm, the high fees come from the big corporations, right? The people that are going to pay them $100,000 a year to do all their stuff. These people that paid a couple thousand a year, they didn't want to spend much time on them. So that's always who I wanted to focus on. But the online version came when I started working with John and Entrepreneur on Fire, because that's who his audience was. So that's kind of, we became known as kind of the expert in that field. And from there it just grew, and I discovered it was a group I really liked working with. And now we basically only work with that group.
Very cool. That's awesome. And I guess we'll just get straight into some of the questions. Our members have some really good questions for you, and then I'll have a few more. Anything that you care to add, we would love that. But I'll just get straight into it. If you're ready,
let's do it.
It'll be kind of rapid fire here. So the first question, do we really need to hire an accountant? Or is it, if we're freelancing, let's say our husband has another job, can we do it ourselves? What's your recommendation? What's your, I don't know, do we really need to hire someone to do it for us?
No, it's a fair question. I guess the answer would be, it depends how comfortable you are with this stuff. Because the thing you have to understand that, especially at first, a lot of freelancers don't understand is, as a freelancer, you own a business. Okay. So a lot of people, when they first start as a freelancer, they have the mindset of they're still an employee in a sense. Cause in some respects it feels like that, right? Because you still have a boss. It almost feels like a boss until you really get going and see that it is a business. So when you're a business, there's significantly more involved with your taxes and accounting than when you're an employee. An employee, to file your taxes, you basically get your W-2 at the end of the year. You file your taxes. That's it. Mm-hmm. That's when you have that, you should be filing your own tax return. There's no reason to pay someone. Once you have a business, things become more complicated, because there's significantly more things you can, what they call write off, meaning expenses that you pay that can reduce the income that you're taxed on. So if you're comfortable, number one, knowing what is and isn't deductible, and number two, properly tracking that throughout the year, and number three, properly doing it on your tax return, then absolutely save the money and do it yourself. In my experience, most people are not. And when they try, they either mess something up on the tax return or miss something that they could have been deducting. So my opinion, I know I'm a little biased, but I think you should. As soon as you actually own a business or a freelancer, then you should be hiring someone, and you're going to get well more than the money you pay for it. But again, if it's something you are comfortable with it, maybe we have a lot of people that maybe they had a business degree and they had a lot of accounting classes and they feel kind of comfortable doing that, then by all means go for it. But for most people, I think they should hire someone from the start there.
Mm-hmm. And I will say from my own experience, it's like always paid for itself just to have someone else do it for me, because
right.
Yeah, you miss so many things. So I'm excited to get into some of what are the deductions, but got a few more questions for you before we get into all that. So when it comes to taxable income, what percentage of our income should we actually be setting aside for taxes?
Yep. So and this is a tough question because there's so many variables. Number one, like, do you have a spouse that works? Do you have another job on the side? Because that's all going to play a factor in how much you're paying in taxes. What type of entity you are you a sole proprietor, an S corp, an LLC? That all plays a part. But generally speaking, if you just want to set something aside to be safe, I would say 20 to 25% of your gross income is a safe amount to at least get you most of the way there.
Okay. So 25%. Okay. That makes sense. And when it comes to paying taxes, do you recommend like doing self-estimated taxes quarterly, or just, I know that's what I do. And then I've got friends who are just like, just wait till the end of the year and deal with the penalty.
Right. Yeah. And I mean, it's sort of, some of that's just personal preference. I mean, the IRS's preference obviously is that you pay estimated taxes because they want that money as soon as possible. And they're going to hit you with a little bit of penalties and interest on it. Now, if you're only going to owe $5,000 at the end of the year, it's going to be a very minor penalty and interest. But if you end up owing $40,000 at the end of the year, you're going to pay a couple, $2,000-$3,000 in penalties for not paying those estimated taxes. So some of it depends on your preference. I mean, we have people that are in both situations, like you said. A lot of them say, I want to pay the bare minimum. So here, let's start with this. Estimated taxes, what the IRS requires is based on what you owed the previous year. Okay, so if you owed $10,000 the year before, the IRS says, okay, this year we want you to pay that $10,000, $2,500 per quarter. Mm-hmm. Right? And then you won't owe any penalty. Even if you end up owing $50,000 at the end of the year, that doesn't matter. You paid what you owed the previous year in estimates if you paid that $10,000. Okay, so some people say, fine, I'll just pay the minimum to avoid that penalty, regardless of what I'm going to owe, and then I'll pay the difference come tax time. Some people say, I don't want to owe a big chunk come tax time, so I'm going to pay my estimates based on what it's looking like I'm going to owe. So every quarter they look and say, okay, I've made $30,000 so far this year. This is how much I should pay this quarter in estimates. And some people say, I don't want the government having any of my money until they absolutely have to, so I'm just going to bite the bullet, pay those penalties, and just pay everything I owe at the end of the year. And again, it's personal preference. My suggestion would be to at least do the minimum to avoid the penalty. But if you want to hold on to that money, and I know there's, especially as entrepreneurs, there's cash is king, right? So there's reasons to hold on to it. Then by all means do it. But my suggestion would be to pay the minimum.
Okay, thank you. Very helpful. And so I've got another question here from someone in the group, and they're asking, as a freelancer, do I need to pay taxes for each project I work on? Or essentially, how do I pay my taxes throughout the year? So I kind of just jumped ahead. So for those of us who have no clue what estimated taxes even are, let's backtrack. How do we know what we pay taxes on? Is it per project? Is it as a whole?
Yep. So that's a good question. It's really confusing for people when they first start, because back up again, as an employee, it's all being taken out for you throughout the year, right? When you get your paycheck, it's already had all those taxes taken out. When you're self-employed, you're just receiving the gross income with no taxes taken out. All right. So that's where this estimated tax comes in. And it's based on what your total income is going to be. So you don't have to sit there and say, all right, on this project, I made $20,000, so I need to pay this much on this project. And on this project, I made $10,000, so I need to pay this much. All you do is take it all together and say, okay, I made $100,000 this year on all my projects combined, so I'm going to owe $25,000, whatever it is. So I'm going to break that out into 4 quarterly estimates based on that $25,000. If that's the way you want to go and project it based on that. But yes, it's always going to be based on your total net income. All right. And so net income means it's after expenses. I'm sure we're going to get into what all those expenses are. But if through all your projects, you made $150,000 and you had $50,000 worth of expenses you could write off, then what you'll pay taxes on is that $100,000 difference.
Okay. I don't even think I knew that. So that's very good to know. All right. And what about bartered services? So what is taxable income? Are bartered services considered taxable, or do we need to file returns on that?
The IRS considers it taxable income. Most people are probably not going to report that income. But if the IRS finds out, they will say, yes, that was taxable income. So if you're going to do it right, then yes, you should include it as taxable income. And it should basically be the value of the services you received. So here's an example. I for the people that do my website, I do their taxes for free. So technically that's bartered services. So the way we should do it is my web guy says, okay, I would charge someone in your situation $3,000 to do what I do for you. So I should be claiming that $3,000 as income. Okay. And then my web guy, I should be telling them, okay, I would charge this taxable income.
All right. So you just kind of estimate what the value would be based on what the service was provided.
The fair market value of the service, basically.
Okay. Good to know. So you mentioned earlier, it kind of depends if you're LLC, if you're just self-employed, if you're S Corp. What are the advantages and disadvantages of a C Corp versus LLC? Or I know when I was setting up my LLC, they suggested like either an S Corp or LLC.
Yep. So for 99.9% of the people listening to this, a C Corp should never be considered. And there's a lot of bad advice out there that tells people they should consider it. They absolutely should not. Basically, a C Corp should be if you plan to be a large corporation that brings on investors as shareholders. Right? If you're a freelancer, that's probably not what you're going for. All right. So your choices should come down to 3 options: a sole proprietor, an LLC, and an S corporation. And there's also legal things that come into play here, which I'm not an attorney, so we won't go too much into that. But from a tax perspective, the first thing you need to understand is a sole proprietor and an LLC are exactly the same. Okay, so a lot of people say, oh, someone told me I need to get an LLC so I can deduct my expenses. Not the case, right? You can deduct your expenses no matter what you are. Literally nothing changes by becoming an LLC when it comes to taxes. All an LLC does is separates you from the business legally. So in theory, if someone sues the business, they can't come after you personally. All right, so that's the first thing to understand. Where the S Corp comes into play is what they call self-employment taxes. So let's get into how you actually pay taxes in any of these situations. Right? You and your business, when it comes to taxes, are basically the same. Right? Your business does not pay taxes. You pay the taxes for your business personally. So a lot of people think, okay, well, my business made $100,000, but I left $80,000 of it in there and never touched it. So I only have to pay taxes on the $20,000 I actually took out. Not the case, right? You're going to pay taxes on all of the profits of your business, regardless of whether you leave it all in the business, take it all out of the business, or somewhere in between, right? So if you get nothing else out of this, drill it in your head that you will pay taxes on the profits of your business no matter what. Okay, no matter what type of entity you are, no matter how much you touch of it, you will always pay taxes on the profits. And again, when we say profits, it's the gross income minus your deductible expenses. Okay, so you bring in $150,000, you have $50,000 expenses, you'll pay taxes on that $100,000 difference. Now, if you're a sole proprietor in LLC, you're going to pay 2 forms of taxes. Number one, you're going to pay ordinary taxes, just like if you're an employee. So that'll come out to whatever your various tax rates come out to. Then on top of that, you're going to pay what they call self-employment taxes, which is an additional 15.3% tax. Okay, and all self-employment taxes are Medicare and Social Security taxes, right? So think back if you've ever had a job when you looked at your pay stub and saw this much went to Social Security, this much went to Medicare, right? That's not being taken out now. So you're responsible for paying that separately. And not only that, now you're both the business owner and the employee. So you're paying both halves of your Social Security and Medicare taxes. So you may not have even realized as an employee, oh, I'm paying the Social Security and Medicare tax. You may not have realized your employer had to match that and pay in the same amount for you. Okay, now you're both the business owner and the employee, so you're paying both halves of that, and that's where 15.3% comes in. Okay, so if you start to make serious money, those two taxes, the ordinary taxes and the self-employment taxes, can add up quickly, especially 15.3% additional tax. Okay, so if you're a sole proprietor or an LLC, that's how it's going to work. You make $100,000 profit, you're going to pay ordinary taxes on that $100,000, and then they're going to turn around and hit you with that 15.3% self-employment tax, which is essentially going to come out to an additional $15,000. Where the S Corp comes into play is it's going to work the exact same way. You're going to pay taxes, all the ordinary taxes on that $100,000 profit, but you're not going to pay that 15.3% self-employment tax. So it essentially eliminates the self-employment tax portion of it.
Okay.
Right, so if it sounds like that's too good to be true, that you can just instantly wipe out $15,000, well, in some respects it is, because the IRS is going to turn around and say, okay, fine, you'll get rid of the self-employment taxes, but we're going to require you to take a salary now and make yourself an actual money from your business. And guess what's going to happen on that salary? You're going to pay payroll taxes, which is 15.3% tax. Okay, so where the savings essentially comes in with an S Corp, and we're getting technical now, but at least it gives you an idea. But essentially, it's going to come down to the difference between your salary and your profits on that business. Okay, so if you make $100,000 profit, you pay yourself. The IRS says it has to be a reasonable salary. Okay, so you can't say, fine, my salary is $5,000. All right, it's got to be reasonable, which generally we say somewhere around 30 to 40% of your net income. Okay, so in this scenario, let's say you paid yourself a $40,000 salary, you made $100,000. That $60,000 difference between the two, you're going to save 15.3% on. Okay, so it's still a good chunk of savings. And the next question is always, well, does that mean I have to leave the $60,000 in the business? No, you can take this out as distributions and not pay any additional taxes on it. Okay, so next question obviously becomes, when does which business entity is right for me? When does the S Corp make sense? And this is where you definitely want to talk to a professional, because it's so specific to your business. But general guidelines are, if you are making less than $30,000 per year profits in that business, meaning after all your expenses, if it's less than $30,000 and you have no concern of legal liability, you are just fine as a sole proprietor. You can hit the ground running, don't file any paperwork, don't waste the time or money, sole proprietor is fine. If you're making less than $30,000 profit and you want to get a little bit of legal protection, go with the LLC. If you're making over $30,000 profit, now the S corporation starts to make sense. Okay. So those are the three guidelines I'd go by.
Okay, that is very, very good information to know. And this next question, you've kind of covered it, but I'll go ahead and ask it as well, so we cover everything. And again, I want everyone to know, like, this is not personalized, custom advice, but take it as you will. But so if someone says, up until now, I've either filed as a sole proprietor, or now as a single owner LLC, and it gets wrapped into my family's tax return as a Schedule C, et cetera. I always have an accountant do our taxes, wondering about best business structures for freelancers and when to move to a model that separates business income from personal income. So I think you pretty much just answered that, but.
Yeah, no, and it's a good question, because it's super confusing. And the thing to understand is, unless you're a C corporation, which, as we discussed, almost no one should be in this scenario, you are going to be what they call a pass-through entity. And what pass-through entity means is those taxes, those profits pass through to you, the owner. Okay, so if you file a Schedule C, all of it's on your personal tax return, so it's easy to see that it's a part of it. But what a lot of people don't understand is, even if you're an S corporation, it's still a pass-through entity. So the business will file its own tax return, but it's what they call an informational return, meaning no taxes are paid there. All those profits are going to pass through to your personal return, and you're going to pay the taxes there. Okay, so no matter what, it's always going to be intertwined with your personal tax return. So that alone, there's no reason to think of, well, I need to get this separated from my personal tax return, because it's always going to end up being a part of your personal tax return.
Okay. And let me see if there's any more to that question. So if their profit or what's left over after expenses doesn't all go in, doesn't all go to into our family's tax return, but is filed separately with the business holding the equity and myself getting paid. So
yeah, so it sounds like that's where she's going with it. But again, the thing to understand is even if you do that, so an S corporation will file its own tax return, but it's going to spit out what they call a K1. And that K1 is going to say, okay, Kate is the 100% owner in her business, and the business had $100,000 profit. And then you turn around and put that on your personal return, and then your personal return is going to show that $100,000 as income, and you're going to pay the taxes there. And that's true. So even in the scenario of an S corporation where you're paying yourself a salary, which it sounds like she's talking about, let's say you pay yourself a $40,000 salary. So that $40,000 is obviously going to show up as on your personal return just as wage income because it's employment income. And then the $60,000 left of profits, it's not just going to stay as equity in your business that you don't pay taxes on. That $60,000 is going to flow through to your personal return and show as profits that you pay taxes on your personal return.
Okay, gotcha. All right. And so we have some freelancers who are not full-time freelancing yet. They're actually still working full-time in another business. So what do they need to know? Like, kind of like, how do they protect themselves from tax pitfalls and
yeah, no, and the thing to understand there is nothing changes compared to for the person that's a full-time freelancer or the person that does it part-time and has a job on the side. It works the exact same way. All right, so you're going to treat it as you own a business, even if it's just a part-time business. That means tracking those expenses, figuring out what your net income is at the end of the year, and then knowing that you personally are going to pay those taxes on that net income.
Okay, so still doing the quarterly estimated taxes from that business's income.
Right.
Right. And then she asked, should I be paying myself a salary from my freelancing income? But it sounds like that gets into the S corp.
Yeah, it's another good question because people get confused on if you're a sole proprietor or an LLC, how do you pay yourself? So the thing is, you only pay yourself an actual salary if you're an S corp. If you're not an S corp, all you do is take distributions from the company. And remember, you're paying taxes on those profits. So you're not paying additional taxes by taking distributions. So if your business makes $10,000 this year, you can take out all $10,000. You can take out $2,000, whatever you want to do, and you're still going to pay taxes on just that $10,000.
Okay. And so another question here, most of us as freelancers, we work out of the home. So it's someone else asking, kind of separating personal and business. She's asking, should we incorporate?
Yep. So that gets back into those three general guidelines of when you should be a sole proprietor, when you should be an LLC, and when you should be an S corp. And all it's going to be based on is what your profits are, and if you feel like you might have some legal concerns. That's all it'll come down to.
All right. And last question before we get into the good stuff of what we can deduct from our taxes. So can I still file as a dependent even if I will make considerably more than I do right now?
Do you know what they mean by file as a dependent?
I don't.
Okay. So
filing jointly, I'm not sure.
That's what I'm wondering if they're going with. Because filing as a dependent typically means your parents claim you on their tax return.
And that could be.
It could be, yeah. I mean, if they're 19 years old and in college, then maybe their parents do still claim them as a dependent. And that if you make too much money, then there could be a chance your parents can no longer claim you. That's going to come down to how much you make and whether you're a student, things like that. Okay. Honestly, your parents' accountant should be advising them on whether they can still claim you or not. Okay. If they're talking about filing jointly, this plays no part in that. First of all, it's almost always better to file jointly than separately if you're married, and your business plays no part in that decision. Okay.
Why is it better to file jointly?
So it strictly comes down to your personal situation and what you each make, what your deductions are, whether you itemize. So there's a lot of scenarios, and this is where if you think it may be better to file separately, you think you may be one of the rare cases, you should definitely be working with a CPA, because what we can do is go in there and say, okay, this is how much you would owe if you filed jointly. This is how much you would owe if you filed separately. But again, I would say 90+% of the time it's better to file jointly.
Okay. All right. So now for the good stuff. What can we deduct from our taxes as freelancers? What should we be deducting?
Yeah. So this question, a CPA's favorite line is it depends. And unfortunately that's going to be what it's going to come down to here. But the basics of it is if you're paying money for something that increases the bottom line of your business, meaning it helps you either bring money in or in some way helps you lower expenses in your business, then you can deduct on your tax return. Okay. So if you go and spend $1,000 on Facebook ads because you want to bring in more money, then that's easily a business expense. Okay. If you hire a contractor to help you in your business, that's easily a business expense. Anything you're spending money on for the purpose of growing your business is almost always going to be a business expense. Okay. So if you travel to Arizona because there's a conference going on that you think will increase your business, all of that travel and the conference is a business expense. So the bottom line you want to think of is what I'm spending money on, is the purpose of it to increase my business? If the answer is yes, it's almost certainly going to be either a full or partial business expense.
Okay. And what about things like if we've got a home office,
Yep.
What about that square footage, our internet bill?
Yeah. So, and this is where it gets a little bit tricky, is can you turn some of these what were personal expenses into business expenses, right? Because before you were a freelancer, you probably already had internet and you probably still use your internet for personal reasons when you're not working. Right? But if that internet is vital to your business, which I'm assuming for 99% of us, we can't run our business without the internet. Now your internet is a business expense. It doesn't matter that you're using it sometimes for personal reasons. You have to have that internet to run your business. So it is a business expense. All right. Your cell phone. Most of us cannot operate our business without our cell phone. So even though you've always had a cell phone, even though you still use it for personal reasons, now that cell phone is vital to your business and it is a business expense. Home office. The key here is it has to be a room that you're using solely for your business. Okay. You can't put a computer in your bedroom and call it a home office. All right. But if you have a room that is strictly your office, you can deduct. So where people get confused, if you're owning a home, your chances are you're already deducting what you can deduct a home office for anyways in the form of mortgage interest. All right. It could allow you to potentially deduct some property taxes or utilities as well. All right. But the big deduction comes if you rent, because you can never deduct rent on your tax return, with the exception of if you have a home office, now you can deduct that portion of the rent. And what it comes down to, as you alluded to, is the square footage of the office versus square footage of the home. So if you have 1,000 square foot home, the office is 100 square feet. That means your office is 10% of the home, and you can deduct 10% of the rent, 10% of the utilities.
Okay. Good to know. And so someone else asked a question about what if they're purchasing business equipment, but it's on a payment plan? So like a computer, she's asking, do I write off the total amount or just what's been paid in that tax year?
Yeah. So this one gets a little confusing because it comes down to cash versus accrual accounting. Cash means you deduct an expense when you pay out the money. Okay. So if you're on a payment plan and you pay $1,000 per year for 5 years, you deduct $1,000 each year you pay it. If you're on accrual accounting, it means that you pay it when the cost is incurred, regardless of when the cash goes out or when you use it. So if you buy a computer now and you're going to use it now, even if you're paying it over 5 years, you deduct the full expense now. Now, for most people, if that sounds confusing, almost all of you will be cash basis payers. All right. So I wouldn't even worry about that. And what that means is you deduct the expense as you pay it. So if you pay $250 of it this year, you deduct $250 next year, et cetera. That's the guideline for probably 95% of them. That's what I'd go with. Cash basis. You pay it as you deduct it as you actually pay it.
Okay. All right. Thank you. And I guess as we're keeping track, it sounds like the main thing to do is to keep very careful records as a freelancer and be very mindful of what you're using. Is there a way to keep track of our expenses that CPAs, accountants really like, that they appreciate it, that makes it easy to make sure we keep as much money as we should?
Yeah, good question. So the key to all of this is keeping proper records. Mm-hmm. All right. And the single best way to do that is to, right from day one, or if you haven't done it yet, go and get a separate account for your business. All right. don't or stop commingling your business and personal finances. That's when things get extremely difficult. All right. So number one, get a separate bank account for the business. And number two, get a separate credit card for the business right from day one. All right. If you have PayPal, same thing, get a separate PayPal account for the business. That's going to make your and your CPA's life immensely easier. After you have that in place, then you need some type of accounting system to track all this. All right. And for some people, that can be as simple as a spreadsheet. If you're just getting started, we have a free spreadsheet on our website, for example, that you can just download. And all you're doing is saying, all right, I went to Walmart and spent $200 on a printer. So $200 in office expenses. I had $1,000 come in, $1,000 of income. All right. If you're just getting started, that's probably going to work fine. What I would recommend as soon as possible is to use some type of cloud-based accounting system. And it's not that much money. So the two main ones that we use typically are QuickBooks Online or Xero, Xero, Xero. What that's going to do is sync right up with your bank accounts and credit cards, right? So if you go out and you have that business bank account, you have that business credit card, it's going to sync right up with that. And every time a transaction comes through there, it's going to automatically come through that accounting software. And all you're going to have to do is go in there and say, it's going to say you spent $200 at Walmart. All you're going to have to do is go in there and code it as office expense because you bought a printer. All right. So it's going to make your life immensely easier. At tax time, your CPA is going to be able to go right in. You can just give them access to that account. They can go right in there and download what they call profit and loss. It's going to show, okay, you had $100,000 income. Your expenses broke down this way. And that's going to be everything they need for the tax return.
Great advice. So is there anything else that I haven't asked that I should have? I'm sure there is.
Yeah, I mean, you hit a lot of the main stuff. So the three things that we always tell people are the most important is the number one, what we just talked about, separating the business and personal finances. Number two, getting the accounting software in place. And number three, getting in the right business entity. So we covered all three of those. The other big one we touched on was making sure you're deducting everything possible and making sure you're not deducting things you're not allowed to deduct. All right. So we've hit all the main things. I mean, if you're doing all of that stuff right, especially from close to day one, you're going to be in fantastic shape come tax time. From there, you're getting into more advanced. You start to make more money. There are obviously more advanced tips you can use. Things like opening up a retirement account within your business, things like SEPs or 401ks, stuff that can drastically reduce your taxable income and allow you to save money. All right. But for most people that are getting started or maybe under that $100,000 range or just getting there, those are the main things. You've got to track this stuff. You've got to have separate accounts. You've got to make sure you're in the proper business entity. If you're doing that, for the most part, your taxes are going to be optimized. You're going to make sure that you're not making any mistakes come tax time.
Great. And you mentioned a couple of resources and tools earlier. Are there any other tools that you recommend to freelancers to kind of help with their taxes?
Yeah, I mean, accounting software is obviously the main thing. Xero, QuickBooks Online. On our website, you can get a free spreadsheet. Go to cpaonfire.com and go to the right-hand corner. There's something that says Know Your Net. Click on that and you can download a free spreadsheet. We also have if the business entity stuff interested you think it's time to start considering an S Corp, we have a free video course that'll show you exactly when that makes sense and how it saves you money. If you go to cpaonfire.com/FireNation. Other than that, yeah, it's just making sure you're using the tools that you get, I guess.
Okay, sounds good. And again, please list those links for us again, because I want to make sure, like, you guys, Josh is giving you great free resources. Please go check these out. I'm sure he'll give you an email or contact information if you are looking for a CPA. So can you, again, just tell us where we can get in touch with you and what are the links to those resources one more time?
Yeah, so our website is cpaonfire.com. We have tons of free articles on there that goes over a lot of the stuff that we were just talking about in more detail, especially if you're just getting started. If you want that free video course on the business entities, it's cpaonfire.com/FireNation. If you want that free spreadsheet, it's just right on the website. You just sign up for our mailing list on the Know Your Net link. And for the accounting software, go to Xero.com, Xero.com, or QuickBooksOnline.com. Or they can reach out to me directly, as you said, via email, josh@cpaonfire.com.
Okay, awesome. Thank you so much, Josh, for your time today. I think you've given us a lot of value here, a lot of new knowledge, ways to save money, keep more money. So thank you for your time. And we'll thank everybody for watching and I hope to talk to you soon.
Hey, thanks for having me.
All right. Bye-bye.